Okay, let's talk AI. It's everywhere, right?
Pretty much unavoidable.
And if you're thinking about the companies really driving this forward, well, Microsoft is absolutely central.
Definitely.
We've seen the huge headlines, the eye-popping investments, the constant buzz. The stakes in this race could not be higher.
It feels like every week there's a new development, a new, wrinkle in the story. It's truly a transformative moment for these tech giants.
It really is. So we've pulled together a stack of sources for this deep dive. Everything from a detailed investor appraisal and analyst reports to the latest industry news.
Right.
We're going to sort through all of it to understand Microsoft's position right now.
Think of it as getting the essential insights without having to comb through dozens of pages yourself. We're distilling it down.
Exactly. Our mission is to understand the incredibly complex relationship Microsoft has with OpenAI, how they're simultaneously building their own AI power, how they measure up against giants like Google, Amazon, and Meta, and what all of this really means for their strategic future and, crucially, their financial health. Ready to dive in?
Let's do it.
All right, let's start at the beginning, the foundation of Microsoft's big AI push, their relationship with OpenAI. The sources really highlight just how massive this commitment has been.
It's more than just a partnership. It's a deep integration built on substantial investment. We're looking at over, $13 billion poured in since 2019?
Yeah, something like that.
It began with a $1 billion investment back when OpenAI was still a nonprofit, evolving as OpenAI shifted to that capped profit structure.
And the core of that deal, Microsoft became the exclusive cloud provider for OpenAI, weaving their technology deep into Azure.
That was the linchpin.
That move gave Microsoft a perceived first-mover advantage in the whole generative AI explosion, didn't it?
Absolutely. Reports indicate Microsoft secured a significant stake, reportedly 49%, in OpenAI's for-profit subsidiary.
Wow, 49%.
Getting that early access to cutting-edge models like GPT wasn't just an advantage. It was a major accelerant for Microsoft's own products and services.
But the dynamic is clearly shifting now. What are the sources saying about OpenAI looking to renegotiate terms? Why the change of heart?
Well, OpenAI's ambitions have grown exponentially. They're reportedly exploring avenues to transition to a public benefit corporation.
The PBC?
Yeah, and potentially launching an IPO down the line. To fund their groundbreaking research and continue scaling, they need tens of billions more in capital.
Tens of billions.
Which, bumps up against the limitations of their current capped profit agreement with Microsoft.
And Microsoft isn't just passively observing this. They're reportedly pushing hard for assurances about continued access to OpenAI's technology beyond their current contract.
Which runs out in 2030.
Right. Does this involve giving up some of that equity stake they secured? Is that the trade-off?
That seems to be the crux of the negotiation right now. Microsoft has considerable leverage. They could potentially block OpenAI's desired restructuring. Their initial investment is massive. And, OpenAI relies heavily on Azure for its infrastructure.
Okay, so Microsoft has cards to play.
But OpenAI has leverage, too. They have the cutting-edge models, the top-tier talent, and their board even holds contractual rights to potentially limit Microsoft's access under specific circumstances. It's a complex power dynamic.
And here's where it gets really interesting. According to the sources, OpenAI is rapidly emerging as a direct competitor to Microsoft.
Yeah, that's a big shift.
We're seeing ChatGPT versus Microsoft's Copilot.
Right.
OpenAI offering APIs directly versus Microsoft's Azure OpenAI services.
Yeah.
They're pursuing enterprise deals head-to-head.
And there are even reports of OpenAI looking into building their own data center infrastructure, separate from Azure.
So not just relying on Microsoft's cloud anymore.
What's fascinating here is how quickly the lines can blur between partnership and rivalry when you have two organizations with such massive, sometimes overlapping ambitions.
Makes sense.
OpenAI's moves towards greater autonomy and establishing its own market presence inevitably create tension with Microsoft's existing and planned offerings.
The sources even delve into the more personal side of this friction. They mention a reported decrease in direct communication between Satya Nadella and Sam Altman. Disagreements over access to computing resources, model access, and even differing views on the timeline for achieving artificial general intelligence, or AGI.
Yeah, that AGI timeline seems to be a real sticking point. Nadella reportedly characterized some of Altman's AGI claims as nonsensical benchmark hacking.
Ouch.
Well,
nonsensical benchmark hacking.
This really highlights the underlying philosophical divergence. You've got a publicly traded commercial software and cloud giant versus a research organization with a unique structure and a focus that can sometimes prioritize, let's say, scientific goals over immediate commercial integration.
And that tension really boiled over during Altman's brief ouster in late 2023, right?
Absolutely. That was a critical moment.
Which, according to the sources, was a critical juncture that pushed Nadella to find an insurance policy.
You got it.
And that policy looks a lot like the Inflection AI acquisition.
Precisely. Microsoft paid $650 million, primarily to bring in key personnel and acquire intellectual property from Inflection AI.
So not just buying tech, but buying the team.
Exactly. This wasn't just a talent acquisition. It was a direct strategic move to significantly boost Microsoft's internal AI development capabilities, providing a crucial hedge against any future disruptions or potential issues with the OpenAI partnership.
So you'd say the relationship has shifted from that initial deep symbiosis to something much more guarded, maybe a frenemy dynamic.
That's a good way to put it, yeah. Frenemies.
A balancing act between maintaining crucial access and aggressively reducing overdependence.
That's the tightrope they're walking. Microsoft needs to maintain that vital access to OpenAI's leading models in the near term, while simultaneously investing heavily and rapidly building out its own AI capabilities.
Right.
The long-term goal is, well, technological independence, giving them control over their AI destiny.
And that strategic imperative leads us directly into Section 2, Microsoft's dedicated push for AI independence. They're not just hedging bets. They're serious about building their own AI muscle in-house.
Absolutely. The sources indicate they're developing proprietary large-scale models, including what's referred to as the MAI series, which are reportedly designed to be competitive with existing OpenAI models like O1 and O3 Mini. They're also focusing on smaller, more efficient models like 5.4.
5.4, right.
Yeah.
Smaller, but maybe more targeted.
Exactly. And the Inflection AI team, led by Mustafa Suleyman, is a major catalyst for that internal effort.
Dude shot in the arm, you'd imagine.
Yeah. That acquisition brought in a wealth of talent and intellectual property, specifically focused on building advanced models, significantly accelerating Microsoft's internal research and development timeline.
Their strategy isn't just about building the biggest possible models either. The sources talk about a focus on efficiency, reinforcement learning techniques, and specialized post-training adaptation. 5.4, for instance, is highlighted for being tailored for on-device reasoning and secure enterprise use cases.
This really emphasizes a practical, application-oriented approach. It's about developing models that are not only powerful, but also efficient, cost-effective, and specifically designed to solve real-world problems for their vast enterprise customer base.
So less about the theoretical benchmark.
And more about practical application.
Yeah.
Exactly. It's not just about chasing, the highest score.
Nadella himself has acknowledged that their in-house models might be lagging OpenAI's by a few months, but the clear strategic goal is to close that gap quickly. Why is closing that gap so paramount?
Well, technological independence is the primary driver. Being able to rely on your own models reduces the risk associated with an external partner, especially one that's, becoming a competitor.
Less dependency risk.
Right. It also offers the potential for better cost control in the long run. Training and running these large models is incredibly expensive.
You hear about the energy costs alone.
Exactly. Controlling the full stack can lead to significant efficiencies down the line.
Now, how does Microsoft actually get all this AI capability into the hands of customers and users? That's where Azure and Copilot come in. Azure is fundamentally the core platform for their AI ambitions.
It's the engine room. Azure is where they deploy their own internal AI innovations, like Copilot, and it's the platform through which they enable their huge base of enterprise customers to build, train, and deploy their own AI solutions.
And Azure AI is a broad suite of services. You've got the Azure OpenAI service, which gives businesses access to models like GPT-4, but within the secure Azure environment.
That's key. For many businesses, they want the power of those models, but need the security, compliance, and existing infrastructure that Azure provides. Peace of mind? Sort of.
But the sources highlight a feature that sounds incredibly compelling for enterprise customers. Azure AI on your data. Tell me about that.
Okay, this is really interesting. What it does is allow businesses to use these powerful foundation models like GPT models or others available in Azure directly on their own proprietary and sensitive data.
Without moving the data out.
Exactly. Without having to move it or undergo massive expensive retraining, it directly addresses privacy and security concerns and integrates with data sources they already use, like Elasticsearch and MongoDB.
That sounds like a major selling point for big companies.
Huge differentiator in the enterprise space, yeah.
They also offer a full spectrum of other AI services, right? Search, agent service, document intelligence, vision, speech, language tools, basically the whole toolkit.
Everything developers and businesses might need. And the Azure AI Foundry acts as a central hub, simplifying the process for deploying custom AI solutions and generative AI copilots.
Like a one-stop shop.
Kind of. You can bring your own models, use Microsoft's or third-party models, and manage them from one place.
Plus, they offer deployment flexibility, like containers for on-premises or edge scenarios.
Which is crucial for businesses with strict data locality or compliance requirements, can't always use the public cloud for everything.
So Azure is positioned not just as a cloud platform, but specifically as a comprehensive, enterprise-grade AI platform ready for complex deployments.
That's the goal. Yeah.
Their main strategy for monetizing AI at scale, weaving it into everyday work for millions, is through Copilot.
Copilot is embedded directly into the Microsoft 365 suite Word, Excel, PowerPoint, Teams, Outlook.
The tools everyone uses.
Exactly. It brings AI assistants right into the tools people are already using constantly throughout their day.
Giving you examples like asking Excel to generate a complex formula based on a natural language prompt.
Or having Teams summarize a long meeting you missed. The sources point to these practical, immediate benefits. Saves time, reduces hassle.
And the stated goals go beyond simple time saving. They aim to enhance decision-making by quickly surfacing information, reduce burnout from repetitive tasks, and, I guess, free up people's cognitive energy for higher-level work.
That's the idea. Let the AI handle the grunt work so humans can focus on strategy, creativity, that sort of thing.
They're also making it customizable with Copilot Studio.
Right, allowing businesses to build their own AI solutions and bots tailored to their specific internal processes, integrating with Dynamics 365, the Power Platform, and even third-party applications.
So you can build your own Copilots.
Essentially, yeah. And there are specialized versions too, like Security Copilot and Copilot for Azure. This deep integration into their existing massive ecosystem provides a colossal competitive advantage and distribution channel.
Hard to replicate that reach.
Very hard. And as we discussed, it's increasingly being powered by their own maturing in-house models.
So Microsoft is aggressively building internal AI, but the sources also show they're not putting all their eggs in one basket. They're looking externally as well.
This is what the sources describe as a strategic dualism. They are building strong internal capabilities and actively exploring models from other providers.
Like who?
They've reportedly been testing models from players like xAI, Meta, Anthropic, and DeepSeek.
Okay, so casting a wide net. Why take this approach? Why diversify beyond their own models and OpenAI?
Well, it's multifaceted. Firstly, it further mitigates risk from the OpenAI partnership. It's another hedge, basically, against a single point of failure or potential issues with OpenAI's models or terms down the line.
Makes sense. Don't be too reliant.
Secondly, it allows them to offer customers a wider selection of models. Not every task requires the biggest, most expensive model.
Only still for the job.
Exactly. Different models have different strengths. And it also signals an openness to embracing open source alternatives, which are becoming increasingly powerful.
And the sources suggest this is part of a larger shift, moving from being merely AI-assisted, which relies heavily on external models, to becoming truly AI-native,
right,
where Microsoft's proprietary models like MAI and 5.4 and Azure itself become the central foundational elements. They talk about the AI model as infrastructure.
That's the long-term vision. Control the core infrastructure layer. And their massive existing ecosystem creates a powerful positive feedback loop, which some are calling the Copilot flywheel.
Okay, Copilot flywheel. Tell me more about that concept. How does it work?
Think about it this way. With Copilot integrated across their vast suite of products, M365, Teams, Dynamics, etc., Microsoft gains invaluable insights.
Usage data.
Usage data, yeah. Always adhering to privacy protocols, of course. But they see how AI is actually used by millions of people in real-world enterprise workflows.
Okay.
This data and feedback are then used to rapidly refine and improve Microsoft's own proprietary models, making them better suited specifically for those core enterprise tasks.
So the models get smarter based on how they're used.
Exactly. Improved models make Copilot more valuable, driving greater adoption and engagement, which in turn provides more data for refinement, leading to even better models and potentially higher revenue through Copilot subscriptions.
So widespread usage feeds back into improving their core technology, which makes their product more useful, which drives more usage. A virtuous cycle.
That's the flywheel.
Good.
And tools like Copilot Studio amplify this by enabling businesses to build custom solutions, further embedding Microsoft's AI and ecosystem into daily operations.
Got it.
By building internal models and being open to integrating third-party ones, Azure is truly positioning itself as a central AI orchestration hub, an AI supermarket, offering choice and flexibility.
Which enterprises probably like.
Absolutely. Especially those wary of vendor lock-in.
As we look at this strategy, it's crucial to remember that none of this is happening in isolation. Microsoft is operating in a fiercely competitive landscape.
Oh, yeah. Which raises a really important question. How does their strategy and position stack up against the other tech titans also pouring billions into AI?
Right. Let's break down the key rivals and their approaches based on the sources. First, there's Google.
Okay, Google. Their strength is their deep AI research history and integration across their vast consumer and enterprise ecosystem. You know, Search, Android, Workspace, Google Cloud Platform.
Everywhere.
Pretty much. They are heavily focused on what they call frontier AI and foundational ML with their powerful Gemini family of models.
Gemini, yeah.
Their Vertex AI platform is a direct competitor to Azure AI, offering access not just to Gemini, but over 150 different models, including many open source options. They also put a strong emphasis on responsible AI and are developing offerings like Agent Space for enterprise AI agents.
So a broad platform play, too?
Definitely. Their research prowess, immense data resources, and massive distribution channels make them a formidable rival.
What about Amazon? Where do they fit in?
Amazon's AI is deeply embedded throughout their operations, from optimizing e-commerce logistics and personalization to being core to their leading cloud platform, AWS.
AWS is still the biggest cloud, right?
By market share, yes. AWS has an incredibly extensive suite of AML services. Bedrock is their key offering for accessing foundation models from various providers, while SageMaker is the leading platform for building and deploying custom machine learning.
Bedrock and SageMaker.
They are focused on democratizing AI tools even for third-party sellers on their marketplace. AWS Bedrock and SageMaker are direct challenges to Azure AI. Their strength lies in applying AI to practical, real-world business problems at immense scale. They know operations.
And Meta, Facebook's parent company.
Meta has made a very public and significant commitment to open source AI with their Llama models.
Llama's been making wave.
Big time. They are building out truly staggering AI infrastructure, reportedly aiming for over 2 million GPUs by fiscal year 2026.
2 million GPUs.
It's massive. AI is fundamental to their social media platforms, driving engagement, content recommendations, and their core advertising business. They've also made a huge investment, reportedly $15 billion for a 49% stake in Scale AI.
Scale AI.
Yeah, a company focused on data labeling and training data for advanced AI. Their open source approach with Llama could potentially commoditize certain layers of the AI stack, posing a challenge to proprietary model strategies. Plus, they have an enormous user base and resulting data advantage.
And then there's NVIDIA, the company supplying the fundamental building blocks, the chips.
NVIDIA isn't a direct competitor in the cloud platform or application software space in the same way, but they are the dominant hardware player, often called the picks and shovels of the AI gold rush.
Selling tools to the miners.
Exactly. They have a full-stack strategy that spans from their leading GPUs, like Blackwell and Rubin, to software layers like CUD, NM, and NeMo, and integrated systems like DGX AI factories.
It's not just chips, then.
No, it's the whole system. Their near-monopoly position in high-end AI chips dictates costs and influences the build-out strategies for all the other major players. Every one of these companies, Microsoft, Google, Amazon, Meta, is a massive consumer of NVIDIA hardware.
So NVIDIA's pricing affects everyone's bottom line.
Critically important to everyone's AI costs, yeah.
So these major rivals each have distinct strategic approaches, whether it's platforms, pragmatic application, open source leadership, or hardware dominance leading to different risk and reward profiles.
Exactly. Microsoft benefits significantly from its deep enterprise channels, the stickiness of Azure and Microsoft 365, and its strong financial position. But it faces real challenges from Google's deep AI research and comprehensive platform,
Amazon's AWS leadership.
Amazon's leadership in cloud infrastructure and practical application, and Meta's aggressive open source push that could, shift market dynamics.
What stands out to you most when you look at the scale of this competition? Is there one thing?
I mean, the sheer mind-boggling scale of the required capital expenditure, CapEx.
The money needed just to build this stuff.
Right. The sources emphasize the massive planned spending on GPUs and data centers across the board. NVIDIA's CEO has even predicted that data center buildouts globally could reach, $1 trillion by 2028?
$1 trillion.
It's astronomical. This isn't just a software or algorithm race anymore. It's fundamentally an infrastructure race that requires colossal funding.
Which favors the companies with deep pockets.
Exactly. Microsoft's strong balance sheet becomes a critical strategic asset in this environment, potentially positioning them to outspend or outlast rivals with weaker financials.
That brings us perfectly to Section 6, Microsoft's financial health and how the market is currently valuing the company in this AI-fueled era. Let's look at the numbers the sources provide from early mid-2025.
Okay, the financial picture is undoubtedly strong. The sources show robust revenue growth exceeding 13% year over year, which is faster than the overall industry.
Very healthy growth.
Yeah. The forecast for Q3 FY25 was solid, projecting revenue over $68 billion, with Intelligent Cloud, which includes Azure, expected to jump a strong 18% to over $26 billion.
18% for cloud, that's significant.
Very significant. Profitability is high, with numbers like EBITDA over $40 billion and gross profit over $48 billion. And their balance sheet is very strong, indicated by a low debt-to-equity ratio around 0.19.
So financially, they're solid.
They have the financial muscle needed for this expensive race, no question.
But how is the market valuing this? The sources mention key valuation ratios. What does a PE ratio around 36.3 tell us?
Okay, let's unpack that simply. The price to earnings, or PE, ratio is basically how much investors are willing to pay for each dollar of a company's earnings.
Right.
A PE around 36.3 means investors are paying over 36 times Microsoft's annual earnings per share. The source highlights that this is significantly above its own 10-year historical average PE of around 31.25.
So higher than usual for Microsoft itself.
Exactly. What does that gap tell you?
It tells me investors are expecting future earnings growth to be faster than historical growth, betting on the future.
Precisely. That higher PE relative to its own history is what we call the AI premium. It indicates investors are heavily pricing in significant future growth that they expect to come largely from AI.
Okay, the AI premium.
The big question hanging over the valuation is whether the tangible revenue and profit generated by AI through Copilot, Azure AI services, etc., can actually justify these elevated multiples over the next few years.
Can they deliver on the hype, basically?
That's the billion or trillion-dollar question.
The sources also mention a PS ratio around 13.03 and a PB ratio around 10.87. Briefly, what do those suggest?
PS is price to sales, indicating how much investors are paying for each dollar of revenue. The source notes this is about 1.5 times the industry average, potentially suggesting the stock is highly valued relative to its sales compared to peers.
So maybe expensive based on sales.
Potentially. PB is price to book, comparing market value to the company's book value, assets minus liabilities. The source notes this might be below the industry average depending on the peer group used.
So a bit mixed depending on the metric.
Yeah, depending on which metric you focus on and who you compare them to, the picture can look slightly different. But that PE clearly shows the market is baking in high AI expectations compared to Microsoft's own past.
And analyst sentiment reflects that optimism, right? The sources say all 20 analysts tracked by Visible Alpha rate the stock as buy or equivalent.
Overwhelmingly positive consensus. Major firms like Morgan Stanley, Wedbush, BMO, Piper Sandler, Evercore ISI are all bullish.
Big names backing it.
Yeah. While some did slightly trim price targets recently, perhaps due to factors like potential tariffs or something, the core long-term bullish view on AI potential remained intact. The sources also note significant institutional buying.
Big money.
Which is often a sign of confidence from large investors.
But despite this general optimism and strong financials, the sources mention a slight stock decline in early 2025, losing almost 8%. What might that signal? A bit of nervousness?
Could be. What's interesting here is that even with a solid strategy and positive analyst reports, the market can get jittery. That slight dip could be investors reacting to the potential risks we discussed.
Like the OpenAI uncertainty.
Exactly. Uncertainty in the OpenAI relationship, the sheer scale of AI investment costs, and the potential for margins to be pressured in the short term, or even just broader macroeconomic concerns.
So maybe a reality check.
Could be the market entering a show-me phase, requiring clearer evidence that AI is driving incremental, profitable growth, particularly from things like Copilot subscriptions and Azure AI consumption in the next, say, 2-3 years.
Meaning that even strong growth numbers, like that 18% cloud growth, might need to be accelerated further by AI to meet the market's high expectations built into that premium valuation. The bar is high.
Extremely high, exactly. This raises the key question. Can the revenue upside from AI products like Copilot outpace the massive capital and R&D costs required to build and run the underlying AI infrastructure and models?
Profitability is key.
Absolutely. That's where Microsoft's financial fortitude, that strong balance sheet and profitability becomes critical. It allows them to fund this extremely expensive race without destabilizing the core business, which is a significant advantage over many potential competitors.
All right, let's look ahead to the next 5 years. Section 7. What do the sources identify as the primary growth catalysts for Microsoft, specifically driven by AI?
Okay, the key drivers they highlight are widespread Copilot adoption and monetization, getting people to pay for it, basically, not just in M365, but across specialized versions and upsells.
More Copilot revenue.
Significant expansion of Azure AI, fueled by enterprises building their own AI applications, leveraging features like On Your Data and the AI Foundry.
More Azure AI usage.
The increasing success and deployment of Microsoft's own proprietary models, which improves product performance and reduces dependence on OpenAI, potentially lowering costs too.
The MAI and Phi models kicking in.
Right. Then the development and rollout of industry-specific AI solutions, growth in edge AI applications using smaller models like Phi-4, and finally those compounding network effects from their ecosystem flywheel.
The flywheel again.
Where more users and more data lead to better models and more valuable products.
But there are also significant risks and challenges over that same period. What are the big ones?
Absolutely. The tangible risks include potential fallout from the OpenAI relationship, especially if there's a major disagreement or disadvantageous renegotiation before Microsoft's internal models fully catch up in capabilities. That's a timing risk.
Right, getting caught in between.
There's execution risk in developing those complex internal models. Delays or performance issues could be costly. Intense competition from Google, Amazon, Meta, and others could lead to price pressure or market share battles.
The competition isn't sleeping.
Not at all. The high costs of AI infrastructure and R&D could continue to pressure profit margins. Potential regulatory scrutiny on AI could impact development or deployment.
Regulation is always a wild card.
And there's the risk of slower than expected enterprise adoption or monetization of AI features like Copilot. Maybe companies aren't ready to pay up yet. Plus, geopolitical risks impacting global supply chains for things like GPUs are also a factor.
Lots to worry about.
Definitely not a smooth ride, guaranteed.
So, synthesizing that 5-year perspective, Microsoft is very well positioned because of its existing enterprise ecosystem, massive distribution channels, financial strength, and a clear diversified AI strategy. The big opportunity is leveraging that incredibly strong base to drive adoption of Copilot and Azure AI.
Huge opportunity there.
But the risks are concrete and could impact that high AI premium valuation we talked about.
Which leads to an assessment of the investment safety over that period. The source is rated as moderately safe.
Okay, moderately safe. What's the reasoning behind moderately safe rather than, say, very safe? Why just moderate?
What's insightful here is the justification. The moderately safe assessment comes from recognizing the inherent stability and profitability of Microsoft's core, diversified businesses, everything from the non-AI parts of Azure to Office licensing, LinkedIn, gaming, etc.
The existing cash cows.
Exactly. These provide a resilient financial foundation. However, the stock's current valuation explicitly includes that significant AI premium we talked about.
There's that premium again.
This premium makes the stock price sensitive and potentially susceptible to volatility if AI monetization or the development and performance of their proprietary models don't fully meet those high investor expectations.
So the company's safe, but the stock price might bounce around more.
That's the idea. The company itself might remain financially sound, but the stock's performance is highly exposed to the success or perceived success of the AI strategy.
Got it. The core business provides safety, But the stock's AI valuation adds a layer of risk to the share price.
Precisely. Well put.
Based on all this, what's the overall 5-year recommendation provided in the sources? What should investors do?
The recommendation is accumulate on dips, hold with confidence.
Accumulate on dips, hold with confidence.
Okay.
And the rationale there. Why that specific advice?
The rationale is the strong belief in Microsoft's long-term potential within a resilient business model. It's viewed as a core holding for investors seeking exposure to the AI trend.
So hold on to it if you have it.
Right. The accumulate on dips part suggests that any volatility or stock pullbacks that occur due to those near-term risks we discussed, like uncertainties with OpenAI or broader market concerns, should be viewed as buying opportunities.
Use the dips to buy more.
That's the suggestion. The core thesis, built on their ecosystem advantage, execution capabilities, and the sheer scale of the AI opportunity, is seen as strong enough to warrant holding the stock with confidence for the long term. The expectation is that Microsoft can navigate the OpenAI complexities, build its internal power, and effectively monetize AI.
Okay, as we wrap up this deep dive, what are the absolute critical factors the sources say we should be monitoring going forward? What should we, the listener, keep an eye on to track this story? Give us the checklist.
Okay, here's a checklist of key things to watch. First, OpenAI partnership milestones. Any news on renegotiations, terms of a potential IPO, and whether collaboration or divergence becomes more prominent. What's the status?
Relationship status. It's complicated.
Yeah. Second, proprietary AI development progress. How are their internal models like MAI and the Fee series performing? Are they closing that gap with OpenAI? How quickly are they being integrated and adopted across Microsoft products?
Are their own models getting good enough?
Third, Copilot adoption and monetization metrics. Are more users signing up for Copilot? How quickly are they converting to paid tiers? What is the tangible impact on revenue? Show me the money from Copilot.
Is it actually making cash?
Fourth, Azure AI revenue growth. Track how fast the AI-specific services within Azure are growing and their contribution to the overall intelligent cloud segment.
How much is AI driving Azure?
Fifth, competitive AI launches and market share shifts. What are Google, Amazon, Meta, and others releasing? Are they gaining or losing ground against Microsoft in key AI areas? Keep an eye on the competition.
What are the rivals doing?
Sixth, AI-related capital expenditures and R&D spending. Keep an eye on how much they are investing in data centers and research, and importantly, the impact this has on free cash flow and profit margins. Is the spending sustainable?
The cost side of the equation.
Seventh, regulatory developments in AI. Any new laws or regulations that could affect how AI is built, deployed, or used globally.
Government intervention.
And perhaps most critically, eighth, the economics of AI for Microsoft. Can they scale these expensive AI services and models profitably? Can they maintain or even improve margins over time as AI becomes a larger percentage of their business? Does the math work out?
Can they make money doing this at scale? That's a fantastic list of things to track. So we've taken the stack of sources and really deep dived into Microsoft's intricate AI strategy.
Quite a journey.
The core story woven through these sources is that high-stakes strategic dance, managing a complex, sometimes strained relationship with a powerful partner who is becoming a competitor in OpenAI,
The frenemy.
while simultaneously and aggressively building out their own formidable AI capabilities in-house and leveraging their existing ecosystem.
It's an incredibly delicate and expensive balancing act, but one they are uniquely positioned to attempt, given their resources and market position.
Absolutely. And here's a final thought for you to mull over, drawing from what we've covered. In this rapidly accelerating AI race, where the technology itself is constantly evolving, is the ultimate path to victory going to be won by the company with the absolute single best foundational AI model?
The smartest AI?
Or by the company that can most effectively integrate, distribute, and monetize AI, whether it's their own models, partner models, or third-party ones, across the widest, stickiest ecosystem of enterprise and consumer users?
Is it about the best tech or the best distribution of pretty good tech?
Right. Microsoft's ability to navigate this co-opetition with OpenAI while simultaneously running its own internal race could very well be the masterclass in strategic corporate navigation that business schools study for decades to come.
A fascinating challenge that will certainly keep us watching. No easy answers there.
Thanks for diving deep with us today. We hope this helps you understand the layers of Microsoft's AI journey a little better. Keep exploring.